Guys, so I wanted to come on here to talk to you guys about options again. I am not a financial advisor, and yet take everything I say with a grain of salt because it's up to you to make your own financial decisions, do your own research. But what I want to talk to you today about is sideways movers and how you can make money off sideways movers. So the one we're going to be looking at today is American Airlines, and this will be focusing on options trading. So for the last year, American Airlines has fluctuated between around $11 a share and gone up to as high as $18 a share. This is a sideways mover. It goes down, it goes up, it goes down. All right. And it stays roughly within those two guidelines, right? So the thing you want to do is purchase at the bottom of the wave and ride it up to the top of the wave, but you need to make sure you sell prior to it going back down. Now, the best thing you can do is buy options to do this so that you can make the most bang for your buck. Personally, I buy 10 contracts at a time or 5 contracts at a time, depending on how it's going. Like if I buy at $12, 5 contracts, and it dips to $11, I'll buy 5 more contracts just because I know it's going to go at least up to $13. So what I do is I make sure I plan to get in at the bottom. Like if they have a really bad day where they're like, oh, we just dropped 5% in one day, that is a perfect time to catch the swing because the swing back up, because it's very dramatic typically with this one. Now, let me show you essentially 1 week of this item. As you can see, it swings up, down, up, down, up, down. And if you catch it in the right moment, you can catch the upswing. You can either do a short term where you want to get in and out within a day, or you can do a long term where you want to get in and out after a few months. Now, personally, I choose to do months as opposed to a day because unless the monthly I choose swings up and hits my threshold in one day, I'm out. Like you got to set clear cut goals and stick to them. And that is essentially what I do. My goal is 30 to 40%, even though sometimes I want to get greedy and stay in there till it hits 50 or 60% and then get out. I don't do it. I make sure I sell at 30 and then I just have the whole FOMO after the fact because I had an option on American Airlines that was expiring in 2025 and I bought it at $12 and I was like 30% I'm out, and it did that 30% and I was out, and then it went up a whole nother dollar and I missed out on all those gains, but I made my profits and I was out. So um, I this is the stock I tend to trade, American Airlines. I also trade Carnival Cruise Lines. And I used to do Hecla mining, but I have gotten away from them because I've just been doing small trades here and there, not necessarily doing a bunch of different people. So right now, I wouldn't buy because it's already $13.46. If I would have got in yesterday, because that's what I wanted to do when it was down to $12, I wanted to buy, but I just didn't log on to do it. My bad, because look at this. Today I would have caught this upswing and I would have been out already. I would have been out already because I probably would have already made my 30%. But neither here nor there. I just wanted to show you guys what I do. All right, so you got to come over here to trade the option. Okay. And once you get on to trade the option, you're going to click buy, call, expiring, minimum 2024, 2025. So January 2025 is an option. Let's buy that. That gives us a whole year for the upswing to occur. And then we can sell on the upswing. We don't want to hold till the end. We don't care about profits after the fact. We want to get out of there before the fact. We do not want to be assigned because we do not have the funds to buy all this stock. We don't have it. So all we want is this contract. And you buy the contract. One contract is 100 shares. And you're buying the right to purchase 100 shares on the strike date that you choose. So if January 17th comes around and the stock is up to $22 a share, I have the right to sell at $22 a share, and I'm paying you your measly $12 that I bought the strike price at. So I get everything in between the $12 and the $22, and I pocket that. Now, and if I wait till January 17th, I'm assigned the shares, I have to pay $22 times 100 shares so I can own those shares. I don't want to own the shares. I just want the money. So I sell to someone else and they get to own the shares after the fact and hold that money, right? So at this point, I just go ahead and buy a call with that right to sell those shares on that date in the future. So I would say, I want to buy a call. And I think by the end of this year, this product is going to be at least $16. So I'm going to buy one for $15. I don't even have to hit my break even price or strike price. I just need other people to think that that's going to happen by the end of the year. I just need it to go up. So if I'm buying it at $1.85 per share, that is $185 per contract because you have to multiply it by the 100 shares that you're going to be purchasing, right? If the product or if the stock goes up to $16 and we're not even broken even, what'll happen is this option will be worth $2 or $3, right? But you bought it for $185. So if it's worth $2, that means that's $200. If it's worth $3, that's $300. Basically, you would sell it for $300, get your $185 back, and everything in between is what you profit. And that's how you make money off options without actually having to own the stock, without actually having to outlay a whole bunch of money. So if I buy 5 contracts at $185 and the stock goes up from 15 to 17, and that means the option's now worth $3. That means I get everything in between times 5, right? So I've made all that money and I get to keep it after I sell the option to somebody else. And then the new person will be owning the stock in the call when the date comes. So that's what we want to do. We want to set it for 30% or higher, whatever you want to do. Or if you feel like things are taking a turn for the worse, you done bought an option and you saw that they done sunk a ship and you bought Carnival Cruise Line. Oh, and you see everyone on the news and you're like, oh, this is going to go bad. Sell your options. Sell them, sell them, sell them, sell them. Get out because it's going to go down. Now, if you see that and you haven't bought any options yet, and let's say that the Carnival Triumph is stuck out in the middle of the ocean and everyone's complaining about it, buy a put. So we won't go into puts this time. I just wanted to talk about call options, but this is how you make money. So I'm thinking I'm not going to buy one now because it's too high. It's already 13.53 and there's going to be a downswing before it goes back up in my thought process. So I'm not going to buy right now, but I'm just going to show you how you do it. So you'll select, okay, $15 strike price, my break even $16.85. All right, no problem. And I have to do that by January of 2025. So I will select that. I've added that into my purchase. This is a long call, $15 call with a strike price of $15. Essentially, it's going to cost me $187. You do need to make sure, hold on, why did you do that? Oh, oh, there's no swing. So there's only the person who offering. There's no one asking. So there's no swing. It is $187. So then you'll purchase it like this, 100 shares. Oh, there it is. So there is a swing. $1.82, $1.87. There you go. And I pick the number in between is an option. If you want it to execute immediately, you can pick $1.87. But if you want it to execute at a lower rate, you can do the mid, which would be like $1.85. So you would pay $1.85. All right, and then you set it good for a day, or you can do good till cancel if you want. And then you'll click your review order. All right, you're paying $185 for the right to buy 100 shares of AAL for $15 per share on January 17, 2025. If AAL shares aren't $15 or higher, the option will expire worthless. So what does that mean? It means that if your bet did not pay off and the stock's worth $10 on that date, you basically paid $185 to someone and they get to keep the money and you made no profit. So only choose things that you think are going to happen in the time you think it's going to happen. That is my advice to you. So that is how to buy a call. I mean, it's pretty simple. You buy and you hold the call until everything works out. Make sure you're keeping in mind if the stock has a dividend, then you need to make sure you keep in mind the dividend dates because stocks tend to dip around dividends. And you need to also keep in mind in the event that they have earnings coming up because stocks tend to dip around earnings. So don't trade or buy options during those times. You should look that up and you can see that on Yahoo Finance without any problems. All right, that's all I got for you today.